Well, hello there. We are live. Thank you very much for joining me. I'm Mitch Goldberg. I am the founder, president of Client First Strategy, an investment firm, a wealth management firm. You're watching Be the Boss of Your Money. This is my live stream where we go over market updates with perspective. We talk about personal finance. We talk about business. We talk about investing, and we get into the weeds. And I'm going to give you perspective because I've been doing this for over 30 years and I have a lot of perspective. I've learned a lot. I have a lot of lessons to share with you. That is the real value of you watching the show. And I greatly appreciate it. It means a lot to me. Yesterday, we had a lot of viewers watching. I think one of the most ever. And I'm really happy about it, especially since the weather's nice and it's summertime. But I want to move on and I just want to keep bringing you value. Today's today's question of the day. The stock market has recovered. We closed at a record high today for the S&P 500. Is it too much too soon? Is it something worth celebrating? Is there something different about this record than the last time we hit a record last February before the pandemic? That's what we're going to find out because I don't think everything is as rosy as the stock market indicates. Duh. But we need to make sure we're on the right track and we're taking the right signals and what we could do next. So stand by. This is going to be a phenomenal show. I've got some major stats here to share with you, some just important facts, things to talk to you about. So we're going to run the intro, the disclaimers, and then we're going to get started. So here we go. 15 seconds. See you in a second. 15 seconds. Okay, we're back. You saw those quick disclaimers I always put up. They are important. Thank you so much for joining me. I'm Mitch Goldberg. You are watching Be the Boss of Your Money. This is the place where you turn to for lessons, information, perspective. This is your place to learn about personal finance, investing, business development, and all of those topics that are related to that. We've got guests coming up. It's all good. I love doing this live stream. I love that you're out there. Welcome. If you have any questions, please ask me in the comments. I see them. That's why I look over here. If you have any questions, ask me in the comments. If you're watching this during the replay, I want to welcome you as well. I'm so glad you are here too. Certainly, you are welcome to ask me any questions that you may have as well. I will see those in the comments. Words of wisdom and words of encouragement are always appreciated just the same. I love interacting with you. I love to hear from you. That is, to me, the best part of doing this. I want to bring you some heavy-duty value today. I'm going to give to you, what the heck got us here, what the heck happened. If you're an investor and you blinked, you missed it. But the stock market, if you haven't heard by now, has not only fully recovered from the pandemic, it's actually more than recovered. The NASDAQ has been hitting highs for weeks now. The S&P 500 just rallied today to close at a new all-time high. Reached an all-time high intraday as well. By the way, an index is something that you cannot invest directly into, but you could invest in a security that tracks or mimics an index. We're still waiting on the Dow, but the S&P 500, I think, is the more noteworthy index that we follow. So just a real quick share screen. I'm going to tell you a couple things, give you the update, and work in the perspective and the lessons and what you need to know about not just the day, but, to become a better investor. The Dow is actually off 66 points. Not a great day for industrials. S&P was up a touch, up, just about 8 points. NASDAQ, the big winner of the day, up almost 1%. That's been on a hot streak for so long already. I lost track of the days. NASDAQ up almost 1%, up almost up 0.75%. And the Russell 2000 off a little bit. The week performer compared to the NASDAQ and the S&P. VIX was, barely budged, 21.5. All right. I talked to you about the VIX, but the VIX is, they call it the fear gauge. That is, the VIX indicates how much professional investors are willing to pay to hedge their portfolios, to hedge their bets. So when the VIX goes up, it means professional investors are nervous. When the VIX goes down, professional investors are, I don't want to say complacent, but less nervous. I don't consider a VIX to be complacent until we get well under 20. Right now, we're 21.5. We'll take a quick look at the watch list, and then we're going to get into the big news today, the record-setting day, okay? Communications, which is just about the same as technology these days. Communications, discretion, consumer staples, technology, the winners of the day. Losers of the day, the ones that I hate seeing lose. Industrials, financials, energy. It's almost like a broken record. I'm almost like getting tired of saying the same three sectors when they're down again. But listen, if we truly had a recovering economy, or at least if investors truly believed that the economy was really on the track to get better, you would see these three, industrials, financials, and energy, you would see those leading the way, not bleeding the way. Man, oh man, that sounded so freaking snappy. I'm going to have to use that. Instead of leading the way, they're bleeding the way. I said that, bleeding the way. That's pretty cool. I'm kind of, I get over myself. I know. Okay, I'll try. All right. So let's take a quick look at a couple of other things. Okay. This was a crazy quarter, crazy year so far. While that comes up, I'll stop sharing the screen for a moment. All right. Record close. What got us here? Did everyone participate? There are, what I said in my announcement for today's live stream, are there three kinds of investors? Two are happy, one is not. All right. So what was your behavior? So I want to talk to you about a couple of things. What got us here is basically not the economy. No way, not the economy. What got us here were the large cap, mega cap tech stocks. That's what really led the way, because not only did the large cap, the mega cap stocks dominate the market in terms of how the market performs, but they also went up a lot. So you just had this massive push from a smaller sector of the market, smaller group of stocks that represent maybe 30% of the market, that really powered the major average, the S&P 500 higher, and the NASDAQ 100, and the NASDAQ composite, and the S&P 100. So basically, your large cap indexes that have a large exposure to technology and communication stocks were the leaders, and that's what rallied. It did not mean that industrial stocks hit new highs. It doesn't mean that energy hit new highs. It doesn't mean banks hit new highs. Far from it. So that's what got us here. This rally was really more about market mechanics, how the environment suited so well the work from home, stay at home stocks like Amazon, Netflix. You know what I'm talking about. Facebook, Amazon, the same stocks, Apple. We talk about these stocks literally every day. But not only did this current environment, this pandemic, favor those stocks, but since those stocks were the biggest companies to begin with, they had an outsized impact on the S&P 500, which is why we're at new records. It's not because, the economy is doing great, the stock market's at a high. So there's not, look, what I said is, to start the show in the thumbnail picture I made, is it time to celebrate? Is it worthwhile celebrating? So look, I don't want to come off as a downer, a curmudgeon. I just want to let you know I'm very excited and very happy that the market's up. I'm happy about the stock market being up at a new high. But in that, there are a couple of flies in the ointment that I'm not happy about. We didn't go up for the reason that we would have liked to have gone up. We went up because the big got bigger. The successful companies just got bigger. Sure, you always want successful companies to do well. That's the way it's supposed to work. But what I mean is, it's just the same stocks. The stocks that do well in a pandemic did very well, and they continue to do well. It's not because of the economy. So that's what I find distressing. That's what I'm not happy about. Unemployment is still over 10%. Walmart, which had a blowout I'm talking a blowout earnings announcement today. Um, Internet sales up almost 100% year over year. Just a great quarter every which way. But even they came out and they said they saw that sales were starting to slow when the stimulus ran out, when the extra $600 per week from the federal unemployment stimulus from the CARES Act ran out. So now that we don't have that stimulus, people were making something like 80% plus of the population was making more money with the CARES Act, the federal unemployment aid, than they were before, when they were working. Now that that's over and people really have to actually buckle down and not just be like, but act like they are really losing their jobs in a recession, how does that impact the industrials, the brick and mortars, et cetera? Because brick and mortar outside of Target and Walmart and Costco, there's really not a lot of happiness out there. So we're going to talk about that, but that's what got us here: the stimulus, the large cap stocks, the work from home stocks, the stay at home stocks, the Zooms of the world, Pelotons of the world. All right. So that's one thing about this year so far. I've got my notes here. Okay. I always want to make sure I have these in front of me. Now, two kinds of investors. If you're an investor that focused, who focused on the tech stocks, the work from home, stay at home stocks, well, you did very well. Congratulations. You did extraordinarily well. Probably the best run you've ever had in your life. Then the meek, the old expression, the meek or the weak, the meek shall inherit the earth. That happened here. If you were an index investor, you stayed true to your asset allocation, your index investments, you pretty much recovered and then some. Good for you. Hopefully you've rebalanced a little bit on the way, and that would have helped juice your returns a little bit. That's something we've been talking about a lot here on this show, that you should rebalance at different times. And I always come out and say that. And then the people who are not happy are the value players, the people who buy the value stocks, the low PE stocks. What we call value now is the trash. It's just value is just like gross, disgusting. So if you are a value investor, you are the one who is singing the blues, who has gotten your butt kicked, and you're just down so much you don't even know what to do. Other people got hurt was people who didn't have good investing behavior. Did you bail out of stocks or your index funds or your investment plan when the stock market was down? You're going to see an awful lot of articles tomorrow and a lot of social media posts from financial advisors, rightly so, that if you didn't have an investment plan that you could stick with, you probably bailed out at a really bad time. You locked in your losses and you missed this entire gain. Now, a lot of people thought we wouldn't see this entire gain for years, but if you think about it, it's August. We've recovered in, it took about 5 months, from the low to get to where we are now. That's not really that long of a time frame if you're a long-term investor. 5 months is, 1 year to me, 2 years to me is short term when you're a long-term investor, let alone 5 months. So that is something that you're going to be seeing a lot about. But if you have behavior that hurt you, like you panicked or sold out or decided I'll sell and then I will wait. Okay. If you decided to say I will sell, and I'll wait till things go lower and then I'll get back in, at a lower price. You really paid a big price because you never really got back in. And even if things did go lower, once you get into that business of selling securities to wait for a lower price, you become an endless procrastinator, because if security prices go lower, you say to yourself, well, they're going lower, so now I'll wait till they go lower. And if they go back up, you say, well, I could have had them lower, so I'll wait till they go back lower. And then it's just endless procrastination from there. This is why I always ask, what good is an investment plan if you can't stick with it? This also has been the year of Robinhood. Now, Robinhood's been around for a while now, but this is the year where Robinhood really exploded onto the scene as not just, not just a day trading app for millennials that was only known in millennial circles, but really the app that everybody became familiar with. This has become the year of the day trader, the Davey day trader. I'm talking about Dave Portnoy from Barstool Sports. And it's just really, there are massive Facebook groups aimed at day traders on for Robinhood, and it's a phenomenon that I've written about, and I've been talking about this and made some video content about, but it's all over the world. So that is another big, massive thing that has happened this year, and it's actually caused movement in the stock market. And you talk about airline stocks, hotels, and casinos. There's been just tremendous activity from the retail trader. This retail trader is very different in some regards than the retail traders that got carried away 99 2000. It's too early to say that Robinhood traders got carried away. Everyone has their prediction that they will have been proven to have gotten carried away, but that could take a very long time to happen. I have no kick against Robinhood. I think it's great, and I think it's great that people are involved with the market and investing, even if they're just trading. It's all part of the process. It's part of the learning process. Better to learn and make mistakes when you're young, I say, than when you're older and don't have the time frame to recover. So Robinhood, what else? This is the year of SPACs, special purpose acquisition companies that would buy companies like electrified vehicle companies like a NIO, and they, or Workhorse. I forget all the names. It's just there's a bunch of them, and these stocks did incredibly well. Special purpose acquisition corporations are just designed to raise money and say, when we see something good, we'll buy it. And we'll buy an entire company, and that's what they do. But they have worked out very well this year, but they're considered aggressive, speculative. I think this round of SPACs are much more sophisticated and have much bigger institutional investors who really are not just throwing money at internet stocks like 1999, 2000. They're just throwing money at electric vehicle stocks, I guess. But they are supposedly, the investors are much more sophisticated. As far as retail traders go, they are supposedly much more tech savvy. They are more tech savvy because they have more tech. There's an article in Barron's that talked about it. Robinhood has become more like a video game than a day trading app just because of its user interface, the UI. But hey, listen, that's how it works. But I think that happened with E-Trade and Ameritrade a long time ago. They were like, playing a video game a long time ago. So stop blaming Robinhood for that. Okay, please, it's enough. Stop being the stock trading moral police. If people want to trade, they're welcome to trade. It's their business. Okay. If you want to warn somebody, fine, but after a while, you have to just say, I said my piece. Okay. And what else? Airline bailouts. The airlines, which bought back almost $40 billion worth of stock in stock buybacks, in an industry where they knew they would always they've historically had trouble staying in business, now are requesting government bailouts. They've gotten a first round of bailouts, and now they're threatening. I say threatening, they're saying, but I say they're threatening that we're going to have another big round of layoffs if you don't get more stimulus money. Everybody's trying to make this pandemic, the economy, as painless as possible. We don't want a painful recession, but recessions are painful, and you can only hold off the pain for so long. So maybe you rip off the Band-Aid a little faster, get it over with, and get the economy back to a new, more sustainable level. We want to help people. I'm not saying we shouldn't help people. I don't want to come off like I'm being insensitive to that. But what we need to do is we need to, be careful with the stimulus. Listen, airlines are getting stimulus, but shouldn't Kohl's and Macy's get stimulus? They employ a lot of people. Steinmart, I think they're based in Florida. They have like 280 stores they're closing. That's a lot of people getting laid off. Maybe we should throw stimulus at them. This is the problem with stimulus. Where do you stop with the corporate welfare? A lot of people would say, Mitch, that's heresy. You should never say that. Listen, I'm a stock investor, and have my clients in the market, so I definitely have benefited from all of these programs. But I'm the first to say, at some point, you have to let the strong survive and the weak go away, and new industries will reemerge. It's scary because you don't know if new industries are going to emerge, but it's always happened before. And then you talk about what's going on in Midtown Manhattan and in other big cities where office buildings are empty, and it's hurting the restaurants and the local economy. People are realizing that they could work from anywhere. That's the biggest thing I think in this whole pandemic, is that if I want to build a firm and I want to hire people, I can now hire people from anywhere in the country. I am not bound by geography. I think it's been like that for a long time. I've been using teleconferencing technology for ages. GoToMeeting is actually what I've been using. And, it used to be a big deal. Now it's like nothing. We have more bandwidth than ever, so we can host Zoom meetings with 100 people and everything works flawlessly. So this is the time when people can work from anywhere, and we are no longer, or at least we finally let it sink in, that we're no longer bound by geography. Okay. So, on March 23rd, we had the low. I came out on March 24th, Tuesday, and I said, you know what? That was the low in the stock market, because if the government's going to bail out the economy and basically take over the economy, we've already hit the low, and the large cap stocks are going to keep going up, the large cap tech stocks. So I'm still sticking to that. I said March 23rd was the low, and I said the further we get away from it, the higher we go, the more that low is going to stick. And it looks like it has stuck pretty good. So I'm still sticking with that call that I made, that it's the low. I know, a little humble brag there, but that was a pretty ballsy thing to do on that particular day at that particular time, to say, folks, we hit the low. I believe yesterday's the low, and it's up from here. And when I say up from here, everything was pretty much up from here. Even the losers this year still bounced off hard from their lows. This is just such a good environment to make money in. And if you're somebody who invests in a 401k plan every month, or just has money pulled out of your checking account every month to invest, you've done quite well, because you've been able to average down, buy more shares for lower prices, and you've really enjoyed a nice recovery. The people that really got slammed were value investors, and mostly, though, the people that sold out at when you're the bottom. And a lot of people did that, and that's why there was a record amount of money that went into money market funds. I think money market funds grew to over $5.5 trillion. And I bet you a lot of those people are still sitting in cash waiting for the real market crash, which we apparently already had. Okay. So that's what did it. I'm going to show you a couple of things to really drive it home. This is going to be interesting. We're almost done, folks. So just stick with me for a little longer, a couple more minutes. All right. This here is Workhorse Group, electronic vehicles, trucks. This is up 451%. You see that? 451% year to date. Close that one. Let's take a look at NIO. NIO is another electronic truck manufacturer, again with no revenues, no earnings. Supposedly they'll get some contracts from the post office. Screens are a little blank right now, but NIO is up something like a couple 100%, and Tesla is up about 350%. All right, so I'm not getting my screens up at the moment, but that's okay. But if you take a look at a company like, to really show you the discrepancy in stocks, Kohl's and Macy's. Okay, I'm going to go back to share screen because they are there. Share screen. Oh my God, this is so good. I love this stuff. Okay, so look at this. Look at this. Look at this. Feast your eyes. All right, you see this? The orange line up here that I don't know if you could see that on your small phone screen, but the orange line is Amazon up 83% year to date. Walmart only up 14% year to date. That's not a bad return, just saying, compared to Amazon. And Macy's is down 58% year to date, and Kohl's is down 60% year to date. So you could see how the large are getting larger, the small are getting smaller. The smaller ones have a lot more employees. So when they get hit, they have a lot more people let go, and it just creates a spiral, a downward spiral in the economy. That's why I just don't think there's so much to celebrate with this market high, because it's really built on a handful of stocks that are benefiting for what I call the worst reasons because of a lousy economy, a lousy, economic environment. That's why. And then we take a look at this. This is when we want to pull up here is a chart of large cap, mega cap growth stocks versus the S&P 500. But the point is the mega cap growth stocks, those are up 26%. And it's already here. I wish I didn't get off there, but I'm going to go back. The mega cap stocks are up 26%. The S&P up about 5%, and small cap stocks down 4%. And small cap stocks, by the way, are small businesses. That's a way we can measure small businesses in the public markets. And they're more subject to the domestic economy, and they have a harder time raising capital as opposed to the mega cap stocks, which are international and have a much easier time raising capital. They could float stocks and bonds and that sort of thing and get good, nice, low interest credit lines for billions of dollars from banks. All right. So enough of that. Let's just see who's out there. I thank everyone who is out there. Hi, Judy, Steve, Stacy, James. Good to see you. We've got a couple of comments out there. Oh, Mike, you are correct. Don't forget Nicola. How could I forget Nicola? That's another one. Thank you. Yep. And also Gary M is out there. Everyone wants a free ride. Yes. I don't know if you're referring to the Robinhood app. That's a free trading app, which is not so free, by the way. They make money because they sell their order flow to other companies. Still really cheap though. Okay. Anyway, I want to thank all of you for watching. Today is a historic day. The S&P 500 hit an all-time high only 5 months after hitting the March 23rd low during the pandemic. The economy has a long way to go. Fixing this pandemic, a vaccine could have a long way to go. We hope we get a vaccine soon. We've got an election coming up, and we're going to have a lot more interesting things to talk about. So thank you. I'll see you right here tomorrow.